Welcome back to 5 Minutes Smart. Today, we are diving into the single biggest question hanging over Wall Street as we enter the July 2026 earnings season. Where is the return on investment for artificial intelligence?
Thanks, Liam. For the past 2 years, big tech hyperscalers, Microsoft, Alphabet, Amazon, and Meta, have poured hundreds of billions of dollars into AI infrastructure, Nvidia GPUs, and massive data centers. But as earnings week arrives, investors are shifting from blind hype to a strict capital intensity audit.
Exactly. The market dynamic has fundamentally changed. In 2024 and 2025, simply announcing a multi-billion-dollar AI data center expansion sent stock prices soaring. Now, in mid-2026, Wall Street wants to see if those massive Capex expenditures are translating into tangible top-line revenue and expanding cloud margins.
Look at Microsoft and Alphabet. Analysts estimate their combined AI-related capital expenditures will cross $200 billion this fiscal year alone. Yet enterprise adoption of generative AI tools and agentic workflows is scaling at a much slower pace than hardware procurement.
That creates a temporary ROI gap. Chip makers like Nvidia continue to post record hardware sales, but the software and service layer built on top of that silicon has not yet unlocked the predicted trillions in productivity monetization. This gap is triggering severe stock volatility. If cloud revenue growth decelerates even by a fraction of a percent during this quarterly report, investors are treating it as proof of an AI expenditure bubble.
On the flip side, supporters argue that building frontier AI infrastructure is a necessary prerequisite. You cannot deploy next-generation autonomous agents without first constructing gigawatt-scale AI computing clusters.
Right. It is the classic build-out dilemma, similar to the fiber optic cable boom in the late 1990s. The infrastructure must precede the application explosion, even if it depresses short-term free cash flow.
But institutional investors are running out of patience. They are demanding proof that software pricing power and corporate subscriptions can justify these historical Capex levels before the end of 2026.
Alice, it is time for our signature segment. What is the smart-sounding sentence for today?
The smart-sounding sentence for today is, as the July earnings season begins, Wall Street is transitioning from speculative AI euphoria to a rigorous capital intensity audit, demanding that big tech demonstrate immediate revenue monetization from their historical hardware Capex.
Transitioning from speculative AI euphoria to a rigorous capital intensity audit, demanding immediate revenue monetization from historical hardware Capex. A sharp summary of Wall Street's current mood.
Indeed, the era of free passes for AI spending is officially over.
To our audience, do you think big tech's AI bets will pay off in 2026, or are we heading for a Capex correction? Drop your thoughts in the comments below. Don't forget to hit the subscribe button and click the notification bell to stay ahead of global macro and tech trends. You can also support our independent production through the Ko-fi link in the description.
Stay smart, stay ahead.
I am Liam.
And I am Alice.
We will see you tomorrow.